come to that in a bit. We've got a lot of experts lined up to tackle all that. At the moment, we are still in the thick of earnings season. We are still in the thick of a lot of news coming in. This one, the stock on our radar, Core Projects, is not on our radar for earnings reasons, but more because the company is also looking at some acquisitions. Joining us now is Nikhil Morsawala, the Director of Finance at Core Projects. Mr. Morsawala, thank you very much for joining us. The news is that the company is set to acquire a UK-based educational consulting services called ITN Mark, and the cost is 25 million. Mr. Morsawala, if you can tell us at what stage this is, when does the deal get done, and what will it mean to your own bottom line? What does it bring by way of sales to your company?
Yeah, well, good morning. The good news is that we completed the deal late last night, London time, and we are now officially the owners of a company called ITN Mark Acquisition Limited. It is one of the largest players in the United Kingdom in the teacher supply and teacher training field. It deals with about 1,600 schools across England and Wales from 16 locations. It's headquartered in Manchester, and it has a relationship with about 5,000 teachers. It has a 5% market share and is number 8 in the rankings in the United Kingdom. Okay. But more importantly, what we feel the key rationale behind this acquisition is that we get access to 1,600 more schools in England and Wales, and we have a very robust and established product called Talmos in the United Kingdom, which we can now cross-sell into these 1,600 schools. So the synergy that will come from this acquisition with our existing UK businesses, we believe is going to be extremely strong and will lead to a higher growth rate than what we have seen in that territory in the past few years.
Mr. Morsawala,
we all know that the United Kingdom
has... I will come to the Core Projects synergies in 1 minute. For the moment, if you can tell us a little more about the company itself, ITN Mark. We understand that it had a top line of about $33 to $35 million. If that is the case, how come you're paying $25 million? Is it a loss-making company?
No, we have. It's been profit-making for the last 7-8 years, and it's been on a steady EBITDA margin of roughly 12 to 13%. I think the standard that's prevailing in the European market for acquisition of this kind is a 5 to 7x multiple of EBITDA. So we have gotten at the lower level of that range at the 5 multiple, and plus the net assets of the company. So I think we have negotiated a good price. It's a very healthy company. It's a cash flow positive company, and it received in fact the best public sector recruitment company award just 2 months back. So it's been recognized by the government of the United Kingdom, and it's got qualification certificates from the Department of Education of the United Kingdom. So it's a very prestigious
Nikhil, we understand that. Morning, Nikhil. We understand that. But if you could tell us more about the company, does it have any debt, and will you be taking on board part of that debt or whole of that debt?
The company comes to us absolutely debt-free. There is absolutely no debt. They had some bank borrowings pre-acquisition, and the deal envisaged taking over the company after they liquidated the debt. So right now the company is without any debt whatsoever in the books.
All right. Also a word on the margins.
And I think.
Sure. Go ahead.
Yeah. Go ahead.
All right. You said that the company has margins of about 12 to 15%. Your own margins are about 35 to 40%. So going forward, what kind of combined margins are we looking at?
Excellent question. I think the whole rationale behind all our acquisitions in the past have been that we have looked at companies with margins which are, say, in circa 9 to 16%, and then our effort has always been to bump up those margins to about anywhere between 20 to 28%. Now, the way this happens is that a lot of the work that happens in these high-cost economies get transferred to our offshore development center in India, and so we are able to leverage our India position and improve the margins. That's point number one. Point number two, what we are also able to do is we are able to cross-sell existing products into the new customer base that we get. That also leads to an increase in the margins of the acquired company. Now, on a blended basis, whilst initially there is a margin dilution at every acquisition, within a period of 24 months, the blended EBITDAs normally would work out to anywhere between 29 to 35%, depending on which territory you're operating in. So our effort will be to ensure that cross-selling happens immediately, and also that we bring down the administrative costs of running this company, which will positively impact the EBITDA.
Okay. So give us an idea of what this will mean to your own P&L in FY12. What kind of revenue growth can we look at? What kind of margins, maybe bottom line growth?
So since the deal has happened today, and if we assume a 10-month impact on the balance sheet of our company for FY12, obviously we'll proportionately get a revenue of 10 months of $35 million or 22 million pounds, which is the revenue. The EBITDA margins, which are today at 12, we have projected that they would go up to 16% by the end of this year, because there's an immediate impact on certain administrative costs which the earlier company was spending, which will no longer be there because of our existing infrastructure in the United Kingdom. So those costs will come down, and we'll have an immediate bump up of the EBITDA from 12 to 16%. Cross-selling will start this year, but obviously the impact will happen only a few months down the line. So the full year's impact will happen only in FY13, and by FY13 and 14 we expect EBITDA margins of this business unit to go up to about 22%.
All right. Finally, how have you funded this acquisition, and have you raised or will you raise any money for this acquisition?
No, we were fully funded for this. We have some internal accruals, and we had some FCCB funds, from the previous issue that we did last year. So the funds were in place, and there is no proposal going forward to raise funds for this particular.
There was some talk that you're raising $100 million via share sale.
Yeah, we have a projected capex plan for FY12 and FY13. You must have seen our announcements. We have gained considerable traction in India. We are now more than 9,000 schools, and which is very, very heartening. And our pipeline today is about 1,300-1,400 crores. Considering the fact that our capex in the next 2 years would be roughly about 1,000 to 1,200 crores, based on this pipeline and based on the anticipated business, especially in the Indian territory, we will have to consider a debt cum equity raise in the next few months. We haven't firmed up our plans, but we are in talks with our bankers and our advisors, and in the next few months we will have to go in for a fundraise of anywhere between 100 to 150 million US dollars, of which a part possibly could be equity, but as I said, we are still in talks with our bankers, and we will take a call depending on market conditions, depending on how the markets are moving and what it is supporting at any given point of time. And of course, the need for long-term funds based on the projects that we are undertaking will dictate what type of funds we will raise.
So, okay, we'll leave it at that. Nikhil, thank you very much for joining us with all those details.